Forms of business organization. If you go to this URL here, it's a California government URL. It shows the general comparison of different ways how a business could be registered in the state of California. For example, you see 1, 2, 3, 4, 5, 6, 7 different forms, such as sole proprietorship, general partnership, C corporation, S corporation, and so on. And for each, it compares the ownership, who owns, who makes management decisions, how taxes are paid, etc., etc. We are not going to look in depth at all of them, but we are going to cover the main three types of business organization. Sole proprietorship, which only includes one owner, a partnership, which has at least 2 people who own it, and a corporation, which has many owners and can be treated as one single legal entity. So, for example, an entire corporation, rather than its individual owners, could be sued as if it's one person. Let's look at a couple of details for each of these 3 types of business. Sole proprietorship. One owner, it's the easiest form of business organization to register. Probably takes just a couple of hours, fill out some forms online. The life of this form of business is limited to the owner's lifespan. Basically, if the owner dies, then the business dies with him. Advantages. Easy to start. You're allowed to keep all profits. You don't share them with anybody. And you pay taxes on the income you make from your business, just like you would be paying taxes on your standard job income. So the income from your business is just basically added to your taxable income from your other jobs you might also have. And this is something that will be different for some other types of business organization, where income is taxed more than once. Disadvantages. Because you're the only one who run the business, whatever money you come up with, came with when you started the business, that's the limit, that's it. So it may be difficult to expand your business. The second and the most important disadvantage is known as unlimited liability for business debts. What it means is that there is no limit to how much you might be liable for if some problem comes up. Let's say somebody sues you for $1 million. If you don't have that much in cash, you might need to sell your house, your car, and other personal assets. So there is a risk of that. And the ownership is difficult to transfer. Basically, if you decide to quit, then if another person wants to take over, then that's kind of an entirely new business now under a different management. Second, partnership. Like the name implies, it has to be at least 2 people owning the business. There are 2 types of partnership, a general partnership and a limited partnership. Under a general partnership, there are at least 2 partners, and they're both called general partners. It could be 2, 3, 4, or more. And the idea is it's just like the sole proprietorship business form, except it's not one but at least 2 people. They share in gains, they share in losses, and they all have unlimited liability for all partners' debts. All partners' debts, which means if somebody sues your partnership, then maybe you already sold your house, but your other partner does not have a house to sell. So you might need to cover his share of losses by selling other personal assets that you have. Under the limited partnership, there is at least one general partner that faces all the same pros and cons as general partners under the general partnership, and there is also at least one so-called limited partner. The difference is, first, General partners are the ones making all the important decisions on, uh, you know, what to do for their business. They run the business. The limited partners are passive investors. They don't directly participate in making all the decisions. Another big difference is the liability. General partners, as always, face an unlimited liability for all business debts, whereas limited partners have a limited liability. In other words, they will not lose more money than how much they initially um, invested into the business when the partnership was formed. But it's the general partners that risk potentially selling any personal assets of their own if something costly comes up. And again, advantages, disadvantages, kind of, rephrasing what was already said. Advantages, relatively easy to start, just like the sole proprietorship. Um, Unlike the sole proprietorship, there is more money that a partnership can work with, since it's several people. Again, they keep all profits. They probably form some sort of written agreement that specifies, clarifies from the beginning how the profits would be split, whether equally or unequally between the partners. And income is again treated like a standard income from some job. So income received will be simply added to all other income that each partner has as maybe the main job. Disadvantages, the funds that the partnership is working with is still probably pretty limited. So it's not like they may have tens or hundreds of $1,000,000 to invest. And the ownership cannot be transferred easily. If one of the partners decides to quit, then basically the original partnership breaks. Now, maybe they continue operating with fewer people, or maybe they invite a new member to the partnership. But either way, the original written agreement does not hold anymore and would need to be completely rewritten, since the partnership is now dissolved. And the last item, the limited partners, as was said on the previous slide, have a limited liability for business debts. That's an advantage of being a limited partner. The general partners face an unlimited liability for business debts, which makes this a disadvantage for this type of partners. And finally, the corporate form of business. Who are the owners of a corporation? For example, who are the owners of Facebook? It's not a couple of people. It's actually probably thousands or maybe even millions of people all over the world who at some point bought shares of stock from Facebook. So those are stockholders of Facebook, of this corporation. What is meant by the separation of ownership and management? The idea is those people who own shares of stock, maybe you own a share or a few shares, you are not actually managing the company. There are different people who manage the company. So there is this separation of who owns it and who manages it. And another thing that's covered with this concept is that the ownership can be transferred, but the corporation still exists. What this means is maybe you decide to sell your shares of stock today, right? So somebody else will buy them. It doesn't mean that since the composition of the owners of the corporation has now changed, that the corporation ceases to exist. No, it's still there. It keeps running its business, but the ownership is now different. And since stocks are traded daily, many times, the stock shares switch hands all the time. This is kind of natural for a corporation. So the ownership composition changes all the time, but the management is still the same, and the company continues to operate. Advantages. Since a corporation is a much larger form of business, it has a lot more funds available to it. It can also raise additional money. Maybe it would like to expand. Maybe it would like to buy its competitor for millions and millions of dollars, right? How would it get the money? It can sell additional shares of stock, and each would bring maybe a couple $100, and combined they bring the necessary hundreds, millions of dollars to make some sort of large investment. The owners, who are the stockholders, right, they basically share in profits. They have a limited liability for corporate debts. In other words, if I own a share of stock of Facebook, the money I paid to get those shares is the most I have lost, right? If somebody sues Facebook, nobody will come after me and ask me to pay more money to cover the cost. And in finance, we say that, at least in theory, firms have an unlimited life. So as long as a firm is profitable and successful, it will be around forever. Disadvantages: it's a lot more difficult to start a corporation. It's a long process which has to be approved by the so-called Securities and Exchange Commission. A lot of paperwork, a lot of approvals, different stages of the process. Another big disadvantage is called double taxation of corporate income. What it means is, first, when a corporation makes money, it pays taxes on that, following the corporate tax income tax rates, which is now 21% flat. And then whatever money is left is used to pay the share to each owner, each stockholder, right? So basically it's what we call dividends that are paid by the firm to the stockholders. And because for the stockholder, the dividends received from the firm is an additional income, it needs to be taxed too at the personal income level. So basically we have 2 times that income made by a corporation is taxed, on the corporate level and then on the personal income level. There are a couple of other variations of business organization forms. For example, there's a hybrid form called limited liability company, LLC, and it includes, the best of both worlds. So it has elements of a partnership where income is taxed only once, and it has elements of a corporation where the owners face a limited liability for business debts. But there are a lot of details for each of the form of business organization covered here. We are not going to go in all the depth, just the general overview. And each form of business has its own advantages and disadvantages. So if you ever consider, starting a business, maybe alone or as a partnership, you should definitely carefully look at all the pros and cons before you make your decision.